Friday morning, good morning. I'm Guy Johnson alongside Lizzie Burton. We're an hour away from the opening trade here in Europe. So what do you need to know? An unprecedented closure at London's Heathrow after a fire cut electrical power to Europe's busiest airports. Flights are being cancelled, diverted. Disruption is expected to last for days. EU leaders failed to pass a €5 billion ammunitions package for Ukraine. We will have the latest on that story from Brussels. Plus, European equity futures are a little lower. Tariff concerns continue to mount. Nike and Fedex have been hit hard overnight. They're becoming the latest companies, just the latest companies, to warn of significant tariff and economic effects. Lizzie.
Well, happy Friday, everybody. Happy Triple Witching Day. And it's been a busy week. It's still not over. It's been a busy week for the central banks. They were meant to give us some direction, but as you can see from the futures picture, futures pointing in opposite directions on the two sides of the Atlantic. European futures here down 0.1%. S&P futures pretty flat. But in the Asian session, you're already seeing those Nike and FedEx earnings weighing on sentiment, kind of barometers of the US economy. Brent trading up a bit, the disruption from the US sanctions on Iran-China flows. It all points back, whether it's central banks or earnings or oil, to the disruption from tariffs from Donald Trump. The countdown to the opening trade starts right now.
Friday the 21st, good morning. It is going to be a busy day. You've got a lot on your agenda. We start with what is happening in West London at Heathrow Airport, Europe's busiest airport, one of the busiest airports in the world. There has been a fire overnight. It is near the airport, not at the airport. It has caused a power outage. Heathrow is going to be shut until basically midnight tonight. We're talking about huge numbers of flights globally being diverted, rerouted, cancelled. Thousands, hundreds of thousands of passengers will be affected by this. The chaos is likely, Lizzie, to last for days. This is unprecedented, I think. I can't remember a time of when I've seen a major European airport being shut like this. Heathrow has had IT issues in the past. We also remember what happened with CrowdStrike. These issues in the past have caused chaos. But I can't remember the whole airport being shut due to a power outage.
Yeah, you obviously have weather issues, personnel strikes, but yeah. I wonder how this compares in terms of the disruption and the economic disruption. As you say, this is Europe's busiest airport. It's not just contained to Heathrow, though. You've also got 16,000 homes in southwest London affected, and the pictures of this are incredible. You know, 10 fire engines, 70 firefighters out there, all 5 terminals shut for the day.
Yep.
But, you know, I'm wondering if this bodes well for that third runway argument. If you've got so much reliant on, is it one power plant, surely, servicing all 5 terminals? Is that real?
It does seem quite incredible that we find ourselves in a situation where there isn't any redundancy built into the system, where there isn't the capacity to reroute power. This is a major industrial hub. You've got to think about it in those kinds of terms. You would have thought there must be some redundancy, but I guess the power consumption of effectively what is a small city is something you would have thought would be thought about, and such critical infrastructure. It raises the questions about the vulnerabilities of such a piece of critical infrastructure to disruption. This may simply just be an electrical fire.
But it speaks to a problem of the UK economy, which is that there is such a concentration in the southeast of England, and when something goes wrong, it affects the whole country and potentially the whole of Europe.
The whole world. Flights are being diverted out of Australia, out of the Middle East, out of America. This is a huge event that will last 4 days. The problem with this, with a kind of event like this, is that it doesn't just get limited to the day on which we're seeing the troubles. Mm-hmm. You have days of aircraft being out of position. It takes a long time, particularly for long-haul flights, to adjust to this. So we can expect, certainly, even if it were to open a little later on today, the chaos to last for the next 2 or 3 days, certainly when it comes to the long-haul schedule. BA, obviously, is the airline most affected by this. I think 1,300 flights roughly go through Heathrow today. Half of that is on BA's schedule. So BA, the most affected airline by all of this. We'll see how IAG stock opens a little bit later on. Let's turn our attention to what is happening in Brussels, or not happening in Brussels.
Yeah, so this personal bust-up I would focus on between Spain's Pedro Sanchez and Kaja Kallas, the EU foreign policy chief, because he was saying, look, look, we need a representative to speak for European citizens here. And she's like, what am I here for then? According to people in the room, at least. Basically, they can't agree on funding for ammunition. That's hit a roadblock. Lithuania saying they don't want to just talk about the numbers first. They want to talk about the principle of sending these, financing these weapons first. But you've got all of those internal arguments while European leaders are essentially worried that they're being sidelined from the Trump, Putin and Zelensky talks going on here.
Internal strife within Europe, unsurprising. There was this narrative that Europe is pulling together. That always was going to be stress tested at some point. This looks like it could be that moment, and you wonder what the ultimate fallout from it is. Is Kaja Kallas really the person that Europe wants to send to put at the table with Vladimir Putin and Donald Trump? That, I think, is the question that Pedro Sanchez is raising at the moment. Obviously, a lot of kind of disagreement over this issue, and raises questions about kind of who basically speaks for Europe, which is the sort of the everlasting question, which again just hasn't been resolved. But it does raise questions about we're basing an awful lot on Europe's ability to do things now, to get its act together when it comes to the rearmament story, to its economy, to so much more. Are we already starting to see cracks appearing in that narrative?
Exactly. And meanwhile, Zelensky ruling out handing control of Ukraine's nuclear plants to Donald Trump, but saying, look, I'm open to the investment if you want to put it there. That might give a bit of a security guarantee.
I think there's another meeting taking place next week with a wider group, so it'll be interesting to see whether or not that is something that gains traction. US markets, so I'm looking at the S&P Monday, Tuesday, Wednesday, Thursday, up by 0.4%. So we're potentially having a positive week, which I think will be the first one in 3 or 4.
Finally.
If we've finally got a positive week. I wonder whether or not, actually, when it comes to the final closing number, whether that will be delivered upon. You highlighted earlier on that we have witching coming up a little bit later on today. This is a huge moment for the options market today, one of the biggest I can remember in a long, long time. So that's going to be a factor. Plus, there's a load of corporate news that looks pretty negative as well. Fedex and Nike. Yeah,
so as I say, these are kind of barometers of the US economy. Fedex cutting its profit outlook because of higher costs and signs of weakening demand. It's pointing to the potential fallout from the trade war down the line. Nike the same, warning that tariffs could affect the earnings ahead. But interesting as well, internally, they're having to make this kind of pivot, or choosing to make this pivot from fashion to sports, and try and reclaim a bit of the cool from Adidas and the takeoff that has been the Samba. And Andrea Felsted been writing about this.
So what was the next shoe? What should we be thinking about?
The kill shot, apparently.
The kill shot. This is a tennis shoe, right?
I mean...
You know more about this than I do. Don't tell me you don't.
What trainers do you have, Guy?
I don't have trainers. I have running shoes. I've got a very old pair of Nikes, which I need to replace, actually. So I'm in the market for a new pair at some point. So we'll see what happens there. But yes, I think Fedex is interesting as well. There's already a story developing around the fact that corporates are struggling. We're going to speak to Salzgitter a little bit later on, one of the big European steel companies, highly exposed to this tariff story. And again, this comes back to this outperformance. Its stock has rocketed recently on the back of expectations that European stocks are going to do better, and it could be one of the beneficiaries of that. Do we start to see cracks appearing in that narrative? We'll find out.
But yeah, they're pretty gloomy about the boost that you'll get from the fiscal, from the new government. So interesting to talk to them later.
Highly exposed to the auto tariffs, highly exposed to steel tariffs. Anyway, we'll focus on that in a few minutes' time, because, as I say, we've got some great guests coming up on the show. Paul Skinner, Wellington Management Investment Director, joining us to talk about the markets. We've got the Salzgitter CEO, Gunnar Grobler, is going to be joining us a little bit later on as well. And Julius Baer, Equities Portfolio Manager, and Rob Arnott, joining us from America, Research Affiliates Chair. Looking forward to that conversation a little bit later. Busy day.
A busy day indeed, including for the economic data. We've got at 12:30 p.m. London time the Canada retail sales numbers, 1 p.m. London time the Fed's John Williams speaking, and then 3 p.m. the EU consumer confidence numbers, and as we say, triple witching options expiry happening later in the day. Valerie Titel is going to dive in for that in a moment.
A bit of data coming up. I find there's a headline just crossed which I'm sort of scratching my head about. The UK is to pause the publication of PPI data, factory gate inflation data, due to data quality issues.
Oh, more data quality issues. I mean, we've had so many when it comes to the labour market, the bane of policymakers' lives. But PPI, of course, really crucial to the BOE.
It's going well in the UK today. It's all functioning as it should be. I'm joking. Let's talk about the stories we're focusing elsewhere on this morning. The President of the United States, Donald Trump, has signed an executive order to boost America's ability to produce critical minerals and potentially even coal. This as he seeks to reduce reliance on foreign imports. The order will provide financing to domestically process critical minerals and rare earth elements. It will also encourage faster permitting for mining and processing projects. Turkey's central bank has raised one of its key interest rates at an unscheduled meeting late Thursday. It's one of a number of moves made by the authorities to reverse Wednesday's sharp decline in the lira. The sell-off was triggered, of course, by the detention of the Istanbul mayor, Ekrem İmamoğlu. He's seen as a powerful potential opposition politician who could challenge President Erdogan in the next general election. And Bloomberg has learnt that UBS is considering relocating its headquarters if Switzerland sticks to its demands that the bank hold an extra $25 billion in capital. Sources say executives believe meeting this requirement would make the group basically just uncompetitive with its global rivals. A draft proposal is due to go before lawmakers in May, but any changes would not likely be implemented before 2028. Feels like a negotiating tactic to me.
Yeah, I mean, clearly they were going to be lobbying for this. The CEO, Sergio Ramotti, already told us they're going to be pushing for a change to this until the very last minute. But, you know, the argument is, from the government and the regulators, they're trying to prevent a repeat of Credit Suisse.
Yep.
And then UBS is like, but hey, we helped out in a big way with Credit Suisse, so, you know, don't overly punish us here. And they're saying it's not just a threat, this is a commercial reality.
I remember when HSBC tried to do something similar. It talks about moving its listing outside the UK. There were various compromises that were made ultimately to keep that listing here. But you've got to look at this from the other end of the telescope. UBS is huge. It has a huge footprint. It is a material risk to any country's balance sheet. If you are the country that takes on UBS, say it was re-domiciled to London, what would be the impact of that in terms of the risk that the UK has to run? So this is not just a, you know what, who wants us? I think there would be a conversation with a number of global regulators about who would be willing to take us. And I think that's the challenge that UBS faces here. It's not just we could wave goodbye to Switzerland to find another home easily. It would be a massive challenge, and regulators in other countries would look very carefully at the risk that they would be taking on in terms of the national balance sheet to take on a bank of this kind of scale. Yeah,
it's a good point. It already knocked the shares yesterday, but, I mean, that regulatory uncertainty has already been weighing on UBS compared to its European peers all throughout this year. So we'll see if there's any more impact at the open. But coming up on the programme, stay with us for more Heathrow Airport updates as Europe's busiest airport's forced to shut for the day. Plus, Nike and Fedex are, as we say, the latest to warn on economic headwinds this year, and we're going to check in on their stocks in the pre-market trade. But up next, tariff uncertainty weighs on markets as the White House reiterates that the big one is coming on April the 2nd. So we'll discuss that. If you've got any questions of your own for our guests, please do send them in to us on IB plus BBTV Go. This is Bloomberg.
.43 minutes until the equity market opened this Friday morning. There's a lot going on. Let's talk about the situation out of the United States first, and then we'll kind of fold that into what we're seeing here in Europe. The White House press secretary is repeating a warning from the Trump administration that further tariffs will come into effect on April the 2nd.
The president has been very clear about his intention for April 2nd. It's going to be a big day for our country. I would encourage all of you to be here to cover the White House that day on April 2nd because there will be big announcements when it comes to reciprocal trade. And the president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly. And there will be big tariffs that will be going into effect.
Caroline Leavitt standing outside the door to the White House, that nice little piece of ground just outside that so much news seems to come from, indicating once again that we are in a situation where we need to worry about tariff escalation. They keep repeating it. Donald Trump keeps talking about how much he is willing to escalate here. The markets have had a bumpy ride this week. Equities in terms of the US at this point are higher, But Valerie, what are futures telling us this morning?
Guy, look, the futures are in the red, and after those comments from the White House press secretary yesterday, we did erase the early declines on the S&P 500 and actually ended yesterday's session in the red as well. However, it's not all bad news when it comes to the equity market, Guy. We are looking to snap these 4 weeks of losses for the broader S&P 500. We are now up 0.4% on the week for the index. Will we see a positive session this afternoon to snap that 4 straight weeks of losses for the index? There could be some risk on the horizon. Those single stock movers that you guys pointed out earlier, Fedex, Nike, Micron, all moving in the pre-market. Also, you need to take an eye to triple witching. This is the option expiry event that happens at the end of every quarter. It's called triple witching because there are single stocks, ETFs, and indices, all 3 options tied to those those equity indices expire this afternoon into the close. We normally see a very large surge in volumes and some volatile stocks, maybe some more less liquid single names have some pretty wild swings into the close. But hopefully we end the session in the green and end this 4 weeks of losses.
Valerie, in terms of the tariff narrative, just walk me through how much we're expecting there, how much is already priced in. The Trump administration keeps pointing us to a bigger and bigger event, it seems, on the horizon.
Look, they've called it the biggest day for tariffs, that they are going to rewire the trade of the U.S. Markets have had a very hard time pricing this in, but we continue to get quite negative news, even out from single names reporting earnings, warning about tariffs, impacting their margins, impacting their profits. So we're seeing it show up even more granularly in the U.S. market. It goes to show, though, whether this trade is going to be in the FX market like it was last year, or if it's going to show up in the wider equity market. But we are braced for that April 2nd day.
It's going to be a big day, isn't it? OK, Valerie, thank you very much indeed. Valerie will be back throughout the morning to keep us updated on what's happening with the markets. Paul Skinner, Investment Director at Wellington Management, joining us around the table. Nice to see you.
Morning, Guy.
Risk on or risk off?
I think it's got to be risk off at the moment. I mean, there's no doubt that we have quite a lot of potential volatility. For us, one of the big issues that we've got is the structural inflation problem that central banks have not met. And as we go forward, that inflation problem means that central banks are literally jammed. They can't lower rates to save the day, which they've done for 18 years or so. And as a result, we are going to see volatility as the market starts to price a higher term premium in the market. And at the moment, we just don't think that long end is giving you the correct discount rate to look at risk assets, to look at equities, to look at credit. So that needs to be repriced. That needs some volatility. And so
the bond market's not going to provide me protection. Is that what you're saying? Normally you'd go, you know what, the world's going to hell in a handbasket. I'm going to buy a US 10-year.
In all honesty,
can I do that?
Yeah, no. I mean, the short end of the yield curve is going nowhere. It's going nowhere. So if you can find high-quality, liquid assets in the short end of that yield curve, you're in very good hands. Cash, actually, there's trillions in there. Cash probably is a great place to be. So short end of the bond market, high-quality things, and let that yield curve steepen, let that term premium come in, let the market readjust, let valuations readjust, then you can start moving longer on that yield curve. You can start looking at risk assets. So there's going to be a time this year where things present themselves extremely well with good value. So what we see, and we're active managers, so we're always looking for opportunities like this, is volatility. And you're going to get it this year. And this big change...
He sounds excited.
I'm hugely excited.
We're in the volatility business around this table, are we not?
Well, no. I mean, it's been an amazing week. It's been an unbelievable week. You've seen this incredible package come out of Europe, which is a game changer, complete game changer. You spend 500 billion euros, 50 billion on defence. That is going to change the economic environment. We think probably up by 1% per annum GDP. That's going to change Europe. And this is the important thing, because Europe has benefited from a current account surplus against the US for 20 years. They've benefited for 20 years of savings. Where have those savings ended up? In the United States.
But so you think that fiscal boost outweighs the tariff threat? Because that is the crux of the question when it comes to the ECB in April.
Absolutely, absolutely. Well, for us, yes, that boost is really going to be looking for people who are going to be investing longer term now. And so those savings that have been parked in the US, and these are huge, they're $15 trillion of European savings, they're heading home because we've closed the economic gap. You know, the GDP is closer to the US. We've closed the yield differential, which was only widened out after the... So we're going to bring money back.
I'm raising an eyebrow because last night Europe struggled to figure out how to spend money on Ukrainian armaments, ammunition.
They can't agree on anything.
They can't. So have we?
Europe comes together in a crisis, and my word, we're ending up in a crisis now. Whether it's Ukraine,
you're certain that's going to happen because at the moment you're seeing a huge outperformance by European assets. Is there a danger that, at least in the short term, maybe that's gone too far?
No, we have to look a little bit long-term than just, the next month. Long-term, it's going to be a great trade. No question about it. Now, it's going to force Europe to start raising capital as a group. You're going to end up with a deeper bond market in Europe. You're going to end up with a bond market that presents, really good...
You're certain of this? Because Europe at the moment is struggling to agree on anything.
Guy, it's a necessity. It's a necessity. America is going home. OK?
Yep.
So that peace dividend that Europe has benefited from, 2 or 3% of GDP expending that they haven't done in defence,
yep,
they're going to have to do that now. And this is what the package is all about in Germany. It's about stepping up, and Europe is going to step up.
But Europe isn't the only option here. There's China.
For...
investing. You could put your money... It doesn't have to be the US. It doesn't have to be Europe. It could be China.
In all honesty, money's going back to China as well. You've got to remember that China own about 10% of corporate bonds across US. That's going back home as well, because actually the China story is not a bad story at the moment. Now, with tariffs at 20-30%, that knocks 0.5%, maybe 0.7% off GDP. If it ramps up to 50 or 60, then, you're taking 1% off of Chinese growth. But we're seeing really good signs that the consumer, white goods, second-hand houses, they're transacting well. We're seeing tech booming there. There's a lot of good things that the central government can do. Plenty of space on monetary policy. They've got very low inflation. Plenty of space fiscally. China's actually quite a nice story. So, yes, it could flow back into China, agreed. But, the problem is going to end up with the US because they need to finance their deficit.
Isn't the danger that we're conflating German fiscal space and European fiscal space? And we're assuming that Europe has fiscal space. Mm-hmm. Other countries do. Ireland probably does. There's a few other countries that have fiscal space. Germany's got the bulk of it right now. Italy doesn't. Spain doesn't.
Yep.
France doesn't. The UK doesn't. We've already seen the data dropping this morning. Isn't there a danger that actually higher Bund yields create a crisis elsewhere? That this isn't as straightforward as maybe just money flowing back into Europe quickly?
The periphery doesn't need to spend that much. The periphery is doing fine. The peripheral economy is actually, in very rude health. So they don't need to spend much. Yeah. Germany, that core, that anchor that has anchored things down, needs to spend. They're going to do it.
Paul, great to see you. Optimistic. Paul Skinner, Investment Director at Wellington Management. Coming up, we'll get back to that European story. Failure to agree an armament package for Ukraine. We'll talk about it next. This is Bloomberg.
Minutes from the start of the opening trade. Futures pointing lower here in Europe by 0.4% following that risk-off mood that we've already seen in the Asia session after those corporate earnings out of the US really have weighed on sentiment. The idea that Nike and Fedex are a barometer of the US economy. But we're going to keep an eye especially on the airline names at the open given the disruption, the closure at Heathrow Airport. FTSE futures are currently unchanged. But if we look to the bond picture, we have the 2-year Treasury yield pretty steady. And across the European space, yields lower a touch at both ends of the curve, Guy.
We'll come back to the bond market in a moment. We'll also take you to Heathrow live in a few minutes' time to get you an update on what is happening there. But before we do that, it's probably worth paying a visit to Brussels to figure out what is going on or what didn't go on last night. France and Italy apparently holding up efforts to deliver €5 billion worth of ammunition for Ukraine. Leaders meeting in Brussels last night also tussled over who should represent the bloc in any potential US-led talks with Russia, assuming that Europe has a seat at the table. Ukraine's president says his country urgently needs the weapons and the ammunition now.
It's crucial that your support for Ukraine does not decrease, but instead continues and grows. And this is especially true for air defense, military aid, and our overall resilience. We need funds for artillery shells and would really appreciate Europe's support with at least €5 billion as soon as possible.
Oliver Crook is in Brussels. Let's find out what happened last night. Ollie, walk us through the evening.
Yeah, so listen, Guy, I mean, this was much more characteristic of what we would call a sort of classic EU leaders meeting, not one that's sort of under the sort of great pressures of an emergency situation in which they had a lot of deliverables. This was very light in terms of delivery. And of course, this was not sort of in the sort of prominence of Ukraine as the #1 issue in defense. This was obviously high on the agenda. But in the press conferences afterwards, they really stressed a number of the other European issues, including competitiveness, trying to reduce bureaucracy, also sort of talking about the tariffs and the impact that could have on the economy. Of course, defense featured, but it failed to deliver on anything really concrete in terms of the proposals. There were incremental steps forwards on that sort of defense white paper in those proposals that Ursula von der Leyen made a couple of weeks ago in terms of sort of funding for defense and other ways to try to get sort of joint procurement and all of that stuff off of the ground. But really, if you remember kind of early in the year, there was an initial sort of premise that was put forward by the High Representative Kaja Kallas that was trying to get basically 40 billion additional euros for Ukraine this year. That was scaled back to about 20 billion. And then it turned into sort of 5 billion for ammunition, and they didn't even manage to get that over the line, right? And there's also disagreements about who should represent the EU in the discussions with Donald Trump, if ever they get a seat at the table. But again, this was much more characteristic of a normal sort of EU leaders meeting. You heard there from Volodymyr Zelensky that basically support needs to increase, not diminish. I wouldn't say that sort of that support has diminished, but I would say it has stayed rather stagnant. And we should say this is the second meeting where we had separate conclusions for most of EU business and Ukraine, where only sort of 26 member states joined Ukraine. That did not, of course, include Hungary.
Ollie, thank you very much indeed. I think we're going to have more meetings next week. We'll see whether or not we make progress at that point. Bloomberg's Ollie Crook joining us with the latest from Brussels. Looks like defence stocks, interestingly, are going to be a little bit higher this morning, which I think is fascinating given the turbulence that we are seeing at the heart of Europe. Steel stocks have also been quite big recent beneficiaries, like Salzgitter stock absolutely rocketing recently. The numbers this morning, I don't know, will they pour a little bit of cold water on that?
Yeah, the numbers this morning somewhat disappointing and the outlook pretty gloomy going ahead. Let's go to them now. That German steel group Salzgitter saying that this challenging economic environment has weighed on performance, and it's reported a pre-tax loss for the fourth quarter of almost €155 million, higher than estimates. We can speak now to Gunnar Grubler, who is CEO of Salzgitter, and it's really good to talk to you, Gunnar. I'm grateful you've made the time for us. You're not the only CEO who's kind of put out a bit of a gloomy outlook in this earnings season. So I'm wondering what the main cause of your gloom is. Is it domestic or is it international?
First of all, thank you for having me on your program. Look, 2024 has been a challenging year. I think for the entire steel industry, not only in Germany but entire Europe. I think I'm pretty happy that operationally we performed very well. We had an operational result of plus 110 million euros. However, as you said, of course we're not happy with the overall outcome for 2024. For 25, though, I think we started with a bit of a gloomy outlook. But you mentioned Brussels earlier on your program. I think what we're seeing in Brussels, but also in Berlin, is a clear focus on base industry in Europe, is a clear focus on steel industry in Europe. We're having the Steel and Metals Action Plan by the EU being published earlier this week. And we see the high focus on infrastructure in defense in spending in Berlin with big decisions coming today. So all in all, I think there is a positive outlook for the steel industry, second half of 25 and then the years to come.
So how much will that economic stimulus from the new federal government help your business, and how fast is it going to translate into earnings for you?
Well, if you take infrastructure, of course, steel is a big part of restoring infrastructure, both on the energy side, think about hydrogen pipes, but also plate steel for bridges and trains and what have you. So that will certainly stimulate the steel industry in Europe. And I expect this to trickle down into orders late 20 or in the second half of 25, and then growing in 26, 27. Given that this is a program for the next coming 5-6 years, I think it's going to support the steel industry over the next until the end of this decade.
Gunnar, good morning. It's Guy. Is it fair to say that European steel is a strategic asset?
I would clearly say yes to that. And I think the discussion around defence that we're having right now underlines very well. The EU Commissioner for Defence has made it very clear whatever comes in terms of defence should be delivered by European companies. Hence, steel companies in Europe that can deliver into defence should be on the uplift here.
So should European steel companies be protected going forward from here? Because there's obviously another factor that we need to throw into the story here, and that is what is coming with tariffs. European steel goes into huge numbers of cars and machines that get exported to the United States. If we do see a hit there and there is the potential for layoffs, should that be prevented in order to protect what is a strategic asset in Europe? How much policy protection should be provided, do you think, when it comes to the tariff narrative?
Well, first of all, I think Europe has already sort of well understood how strategic the steel industry is. You have seen a review on safeguards that will now be implemented 1st of April. You have seen sort of other tariffs on steel imports into Europe, which is exactly the right measure at these times where you have uncertainties on tariffs in other places of this world. Especially the US, what we see is not necessarily that the direct export of steel into US is the problem, but rather steel imports coming from other regions that cannot enter US anymore, that they will be dumped in Europe. That problem is well understood in Brussels, and measures have been taken. But of course, if the overall tariff stories continues and exports from Europe into the US become more difficult, there will be some kind of effect on the industry in Europe, and hence also on the steel industry. But to me, it is too early to say how that will play out. Hence, too early also to give you a straight answer to that.
OK, so that on the tariff picture. Let me ask you, Gunnar, about your hydrogen outlook, because given your green steel project, I'm thinking about your rival ThyssenKrupp. It said that it won't be able to run its direct reduction plan with hydrogen until 2027. It's going to have to use gas instead. Are you seeing similar impacts? Is your 2026 target still realistic at this point?
Well, first of all, given that we will be connected to the hydrogen backbone in 2029, we have a bit of more time. We are producing our own hydrogen with a 100-megawatt electrolyzer that we're building as we speak. And the additional hydrogen that is needed will then be added as of 2029 with a certain ramp-up. We have launched an auction on hydrogen summer last year. The outcome of that auction was very positive in terms of volumes. So volumes are there on the global market. What we're now discussing, obviously, is also the pricing. So there we certainly have to continue the dialogue. But I would say there is a clear path to hydrogen globally, and then also with a clear impact, positive impact on Europe. And hence, we will be able to deliver green steel based on hydrogen and green electricity. Yes.
Gunnar, do you think the story around sustainability, though, is fading from the spotlight? There is clearly an emphasis on growth. There is clearly an emphasis on strategic importance of certain key industries. Is it more important to have those industries functioning and delivering steel than worrying about what the inputs are? Is the narrative changing, do you think, around some of the targets that are being set on sustainability, that there are more important elements of the industry that are going to be focused on going forward from here? As I say, strategic, global importance. The sector has a huge strategic and global importance. Does Europe need to focus on that rather than worrying about hydrogen?
Well, I think the strategic importance of steel underlines and supports the transformation the steel industry is undergoing. We are on our way already to green steel, and our customers are still asking for it. So we don't see a shift in the customer demand for green steel. Why is that? Because they have given themselves SBTi targets. They have given themselves CO2 reduction targets. And in order to fulfill those targets, they need to, or the easiest way to get there is through green steel, because the green steel will reduce the CO2 content by up to 95%. That's the easiest way for a machinery manufacturer, infrastructure, etc., to reduce the CO2 footprint. And what we're seeing in the political discussion is that through lead markets for green products, steel, cement, and others, you also stimulate the green steel. Hence, the green steel will be a growth market in the future.
Gunnar, thanks for the time this morning. Really appreciate it. Gunnar Grobler, the CEO of Salzgitter. So much going on in that sector at the moment. Definitely worth paying attention to. I want to take you back to the big story of the morning, and that is what is happening at Heathrow right now. Heathrow looks like it's going to be closed all day. This is Europe's busiest airport. It is going to have a long-lasting effect in terms of the impact that we are going to see on global aviation. I think that probably will last 2 or 3 days. You're looking at a live shot coming to you from Heathrow. That's obviously the entranceway to Terminals 1, 2 and 3 at Heathrow. But as you can see, while there's some activity on the ground, no activity in the air. We'll have the latest on the story next. This is Bloomberg.
Welcome back to the opening trade. We're 15 minutes away from the open. We could talk now to our Markets Live executive editor, Mark Cudmore, who's got an eye across all of these trends happening in the markets. And I want to start in the bond market, Mark, because the yield curve's been steepening a little since the Fed decision. But my question to you is, why isn't it steepening more?
I think it should be steepening much more. Good morning, Lizzie. I think the clear message out of the Fed was that tariffs are both going to be negative for growth and inflationary, the stagflationary impulse. But what they said is they care about the growth part. That's the bit they're really worried about. So, i.e., they're going to ease policy if they need to. They're still talking about 2 rate cuts this year. So that should put pressure on the front end. Meanwhile, they're saying that even though tariffs are inflationary, they're going to cut rates. So therefore, that should see people get concerned about the long-term inflationary consequence. Does the Fed risk making the same mistake that it made only a few years ago of saying that the inflationary impulse is transitory when it wasn't, and have to react really, really aggressive about it? So therefore, that should be a big steepening impulse. And then only whatever it was, less than 12 hours later, we had Donald Trump come out and put pressure on the Fed to ease rates, even though we do have this ongoing kind of inflation pressures, not just from those tariffs, but from non-oil commodity prices as well. So therefore, I thought these two dynamics should have seen a real steepening of the curve. We've seen a slight steepening of the curve since the Fed. It has worked, but to me, the 2s10s curve should be much higher. 44 basis points is the 3-year high in 2 years, 2s10 spread. I think that should break in the next couple of weeks. I think it'll happen but into the next 2 weeks. I'm wondering what I'm missing.
Let's talk about the equity market, Mark. S&P is up by, 0.4% at the moment on the week. That feels very unconvincing as a bounce. Let's say we kind of remain at these sorts of levels. What is the signal that I can take away from the fact that equities are not, as they have done over the last few years, bouncing back sharply?
Yeah, the price action is just terrible. And I think the takeaway is that, all those people who buy the dip are starting to run into people who just long-term structural outflows that are starting to come out. Now, those long-term structural outflows are very slow, very gradual. They'll happen over several years, but that dynamic we expect to sustain. But they're already sufficient to be counteracting those dip buyers. And I think that reflects the fact that the price action is absolutely terrible. And I think that ultimately we're going to see stocks go much lower over the long term.
Mark, it's a miserable morning for Hang Seng and China stocks today. Really miserable session. The Hang Seng down more than 2%, as is the MSCI China. Is there more room for a bigger correction here?
I think so. I think we've just seen such extraordinary gains in China, Hong Kong. As you know, I'm very bullish in this dynamic. I think that last September heralded the start of a longer-term bull market in Chinese and Greater China assets. I think that Hong Kong is the discounted way to play that. We've seen stock markets up a large amount since then. It's been a volatile fashion, but ultimately they're up a long way in a market that, in a world that's going to much more uncertainty, where other markets are struggling. They've come off a few percent from the peak. They could fall another 8 or 9% here and still be in the longer-term bull market, and that's what I expect to happen.
All right, Mark Cudmore, our Bloomberg Markets Live executive editor, we thank you. And remember, you can get up to date on Mark's team's analysis, its insights, by going to MLIV Go on your terminal.
Let's get the latest from Heathrow right now. It is shut. There has been a fire overnight. There has been a power outage. This is Europe's busiest airport. Thousands of flights are going to be cancelled. Hundreds of thousands of people will be affected. Alex Morgan is outside Heathrow right now. Alex, do we have any idea at this point how long the airport is going to be closed for?
Well, good morning, Guy. I think, first of all, it's quite strange to be stood here and the skies above Heathrow are completely quiet. Not a plane, nothing. I was speaking to our colleagues on the global aviation team at Bloomberg, and I was saying, how do you frame this? And they're saying a closure of this sort for an airport like Heathrow, we're talking right the way up to midnight tonight at least. They said that's unprecedented. We've had outages in the past, a couple of hours for air traffic control, etc. This is an entire day closure. So part one of this story, if you like, Guy, are the 120 aircraft that were already sort of in the air on the way here. They had to be diverted. Part two, all those flights that obviously were due to leave today. And then part three, the knock-on into the weekend. Because it's not just, of course, the aircraft that couldn't land. It's all the crews and the aircraft that need to be positioned for those flights in the coming days. Now, you're saying there, Europe's busiest airport, typically 200,000 passengers a day, 1,400 flights. Today, nothing. All of that closed until at least midnight tonight.
Alex, you've got to stay with us throughout the morning, keeping us updated on what is happening here. Alex Morgan, outside Heathrow Airport. Let's get this bigger picture story now. Benedict Campbell leads our global aviation coverage. Betty, let's talk about the impact of this. Let's first of all start with the unprecedented nature of what is happening here. This is Europe's busiest airport. How is there no redundancy? How is there no power backup for an airport of this scale and importance?
That's a very good question, and I'm sure that's something that will be closely probed in the coming days. But the situation right now, as we just heard, is this really unprecedented closure. We had, disruptions in the past. We've had weather-related disruptions. We've had strikes. We've had air traffic control outages. In 2006, we had the terror attacks in London. But even then, you didn't have a full-day, complete lockdown of the airport. This is really unprecedented. But to your point, the aviation industry is really built around redundancies. It's built around having safe systems that are foolproof, that sort of kick in if one thing goes wrong. So how this substation, which is where the fire started, that's about 2 miles away from Heathrow, how that could knock out Europe's biggest airport and busiest airport, that's really going to be a question of much debate. It's not just the airport, it's also people in the vicinity that are affected, but obviously the airport is the big one that got hit here.
So if Europe's biggest airport can be closed for a day because of something like this, Benny, does it mean that there'll be a rethink about whether Heathrow can actually handle a third runway?
That's actually a very good question. This comes at a very inopportune moment for Heathrow, who are trying to prove that they are fit for purpose, that they are fit for the future. And here you have essentially one glitch, shall we call it. It's obviously bigger than a glitch. It's a pretty substantial blaze, really knocking out this massive artery. So other airports might be looking at this and thinking, OK, what can we learn from this? We did have a case in Frankfurt a couple of years ago where a digger dug up a cable, and that led to the airport also closing down. And there, a similar discussion, like how can it be that one single cable can knock out something as important as an entire airport? So a lot of questions around what the infrastructure is like. Is it creaky? Is it outdated? Does it have the right redundancies? Yeah. Those are the types of questions that people will be asking.
Benny, just give us a sense of the scale of the disruption, not just at Heathrow, but other airports in the UK, other airports around the world. How long does it take to correct a big closure like this at Heathrow? What are the ripple effects that are going to stem from it?
We're talking days here, really. I mean, you're talking about initially the first phases of the aircraft that were in the sky. For instance, there was an Etihad aircraft from Abu Dhabi that had to land in Frankfurt. Probably not where people wanted to end up. And that means you need to find alternative mode of transport. You might need to put the people up in hotels for the night. That is hugely expensive. You need to work through immigration. So a lot of crisis control at the airlines right now. Emirates, which is a huge operator into Heathrow, more than half a dozen A380s that sort of rain down on Heathrow each day. They've cancelled their entire morning service, and the afternoon also looks very, very patchy for them. So we're talking thousands of people here for each airline. British Airways alone is by far the biggest operator, more than 600 flights a day, followed by Virgin. Virgin have said the morning service is off, the afternoon service unclear. So these massive ripple effects with aircraft out of position, crew out of position, passengers out of position, that's going to take well into next week to get sorted out again.
OK, miserable times for Heathrow and all those passengers and crew affected. Bloomberg's Benedict Camel, we thank you for the latest. Of course, we're going to be keeping an eye on the airline stocks at the open, particularly IAG, given that it's the owner of British Airways and this is its home. But the open trade is coming up. Futures in Europe pointing lower. This is Bloomberg.
Friday the 21st, good morning, folks. Busy session in Prospect. Lots going on around the world. We've got the Heathrow story to fold into the opening trade as well this morning. But let me give you a little bit of a history lesson as to what happened yesterday and what that tells us about maybe how we're going to open this Friday morning. White line, Europe. Blue line, the United States. We go out here, a little bit of a fade from there. Basically, the US back end of the session probably actually reasonably static, but you've got Fedex and you've got Nike to fold into that story as well, which is why futures in the US may be looking a little bit negative. Remember, we're up by around 0.4% on the S&P so far this week. The European markets are actually up by 1.2%, so a little bit of a cushion for Europe going into the Friday session, but we are negative to the tune of 0.4% on the 50. DAX futures are down by 0.5%. S&P futures are a little bit negative, but the other story we need to fold in there is what is happening with the witching. We've got a big options expiry coming up a little bit later on. That is going to provide significant volatility into various kind of key moments within the session. So it looks like a reasonably negative start to the day here in Europe, Lizzie.
Yeah, and it could be particularly negative, as you say, Guy, for those airline stocks. We look to the likes of IAG, Lufthansa, Air France, KLM, Ryanair, EasyJet. Of course, Heathrow Airport is the home to IAG's BA and Virgin Atlantic, and this fire at the electrical substation is leading to a power outage. The airport closed all day. Also keeping an eye on Dassault Aviation, the CEO saying that France may order about 30 extra Rafale jets, and UBS, a big scoop from us here, UBS looking at moving its HQ out of Switzerland in response to the capital buffer rules. All of that to watch at the open, Guy.
OK, let's talk about this open. The Friday open is almost upon us. It is time for the opening trade. Let's show you some numbers, give you an idea of what is happening. We are expecting some negativity early on in the session, but there's lots to get through throughout the rest of the day. We're going to fold in what is happening with the aviation sector first thing into Europe. But there's a few other corporate stories we're going to be watching as well. We were talking to Salzgitter a little bit earlier on. But the expectation is that Europe is going to open soft, and we're already seeing indications of that. We're not down by much. We are, as I say, on the week for the Stoxx 600 by around 1.2%. So there's a little bit of a cushion maybe for Europe going into the weekend. We are down by 0.4% on the Stoxx 600. Unsurprisingly, and I'm sure this banner will appear on the bottom of the screen for you in just a moment, Lizzie, we are seeing IAG, the parent of British Airways, opening a little softer first thing this morning.
Down 2.2% as things stand. You're also looking at weakness for Lufthansa. That's down more than 1%. Air France, KLM down 0.5%. EasyJet down 1.1%. So misery for the airline names this morning. I was looking for maybe some weakness in terms of the European insurance names, given the travel insurance impact of this as well. Direct line shares down 0.3%. Swiss Re down 0.7%, but just red across that sector this morning. But as you say, it's red across the European equity picture picture this morning. We've got the CAC down 0.5%, still waiting for the DAX. And though if we look at the sectoral picture as things stand, travel and leisure, as you would expect, absolutely bottom of the basket, down 1.3%. 18 out of 20 sectors in negative territory this morning. Only telecoms and utilities, Guy, eking out gains this morning.
Let's give you a sense of the breadth and what is happening here. So down, 481 stocks are down in the Stoxx 600. Lizzie Burton pulls the face. Only 84 at this point are tracking high. I've got 33 unchanged at the moment, but the balance definitely very negative right now. As I say, 480 stocks out of 600 are currently tracking lower. In terms of where the damage is being done from a points point of view, it is ASML, Novo Nordisk, Schneider, Siemens, Nestle, Danske Bank and LVMH. Some big names, but a fairly big and eclectic mix there in terms of the sectors that they operate from. HSBC is tracking a little bit higher. In terms of the airlines, let's show you some names in terms of the airline story this morning, just to give you an idea of what is happening with the travel story first thing. Unsurprisingly, we are seeing some pressure here given what is happening at Heathrow. This won't just be a Heathrow story today. This will affect airlines across Europe. And while you can see that IAG is the big loser, down by 3.1%, other airlines in Europe are certainly seeing significant weakness as well, Lizzie.
Indeed. Well, let's speak to Anne Doe now, portfolio manager at Julius Baer, who, of course, specialises in equities. So it's great to have you at the start of trade. I mean, this Heathrow closure, I think, just really speaks to all the struggles that the UK is facing at this time when we really, really need some investment. We've got the Chancellor's spring statement coming next week. Can the UK invest its way out of this?
Good morning. Thank you for having me, Lizzie and Guy. Look, it's not just a local problem. Like, I think the growth concern and potential for slowdown, that's a global question at the moment, not least in Europe, but also in the US. So the global concerns around growth, that question around can growth continue, that's been a headwind for markets recently.
Well, of course, it's been a huge headwind in the US until a decent week so far for the S&P. But, yeah. I mean, yeah, I'm not going to speak Greek here, to Guy's pleasure. What's the read-through from that US misery when it comes to European stocks?
I think that goes some way to explain the European outperformance year to date. There's been strong outperformance in Europe. In portfolios, we have been running an European overweight, but that includes a more defensive element of Europe, like Swiss stocks. You know, that the Swiss market is very big in pharmaceuticals and consumer staples. That's maybe different from, I guess, your typical European stock. We've been thinking about just that position going in, including some quality growth names that we're also happy to hold over the long term. When you think about whether that rally can continue, relative valuation is not that cheap anymore, right? The European relative valuation versus the rest of the world, that's back to levels we've seen before Russia-Ukraine. So the opportunity set is not that cheap anymore. And secondly, our team crunched the numbers and look at what happens when the US slow down, what happens when the S&P 500 is in a downtrend. Yep. Actually, the rest of the world tend to underperform, tend to suffer as well. So we're in an unusual situation when the US is in decline and yet the rest of the world is rallying.
Lizzie doesn't let me talk about the beta, but that's effectively what you're talking about.
Effectively.
OK, so it sounds to me like you're feeling fairly defensive at the moment. What do I do? What does a defensive portfolio look like?
You know, there's a level of uncertainty out there, not least when it comes to policy uncertainty. Just the level of change in policy making drives cost of concern. So we are relatively defensive. We're not rushing to buy the dip. In terms of portfolios, we still have a high level of cash. We're holding a gold position. We're overweight duration. So government bonds have actually provided a decent level of protection for multi-asset portfolios this year. Yeah.
If you don't get a recession, does credit help? Because if defaults don't pick up, you can sit and clip a coupon for a long time here, assuming that you don't get a deep recession, that growth slowdown that you're talking about doesn't become significant. Are there ways of generating income that look reasonably defensive, and is credit one of the ways you would look at, or do you worry about pricing being as tight as it is?
I would say we're more on this latter, right. So we're more worried than... So in terms of high yield, so that credit component, where do we fall in that credit rating? So we're underweight high yield because we're still concerned about that potential for spreads blowout. It's not happening yet because the economy is not in a recession. The economy is simply slowing down in the US from a very high rate of growth to simply a slower rate of growth.
But in terms of how you would rank, like in terms of the defensiveness, how do you think about equity versus credit versus the bond market? You talked about gold. Like how are you kind of rethinking the relative risk in these various asset pots that people will have in their portfolios?
So within the various opportunity sets, we're neutral in equities. We remain diversified regionally. So we have a bit of Europe, and we also adding China to portfolios starting February. So we're maintaining regional diversification to build in that defensiveness in terms of relative valuations, creating that spread of opportunities within the equities. In fixed income, we like duration. We have a small overweight in duration in London. In credit, we're underweight high yield, neutral on investment grade, and overweight emerging market debt. So that's where we are in terms of the opportunity set.
That's interesting. So how do you weight Europe and China then?
So those were, I guess, the talking points coming into this year, right? Those, in terms of the starting point coming into this year, both markets were at very steep discount. Both markets have rallied. I think the story for China, it really came down to a few things. First thing is around DeepSeek, and DeepSeek really showed us that Chinese companies have remained really competitive. And secondly, policymakers have started to sound more market-friendly. They talk about raising the fiscal deficit. They're meeting with private market leaders. They're showing a more friendly face. So that Chinese story look attractive to us.
For the last, I can't remember how long it is, years and years and years and years, you basically wanted to be massively overweight the US. The exceptional trade was on.
Yeah.
That's how you outperformed. If you really wanted to outperform, you were in US tech.
Yeah.
Is that over?
It comes down to a question of time horizon. In terms of the short term, it's true that the US has a few questions around policy uncertainty. But I do think it comes down to timing, because all of the negative side of policy making, like tariffs, like fiscal budget cuts, that has been front-loaded to this year. Whereas the more positive side, let's not forget that the administration is also talking about tax cuts, talking about a more pro-growth stance in the U.S. That's probably coming later. So for the U.S., I think there's a timing issue here where in the short term there could be noise. But over the long term, that's still where the productivity story is. That's still where the technology innovation is happening. And let's not forget that the market is energy independent. The market has a strong labor market. So in the long term, we still like the US, but over the short term, there's probably still some questions.
Okay.
Anne, can I ask you about another kind of defensiveness?
Yeah.
You've got this huge change, a paradigm shift in Europe, the era of rearmament, right? These commitments to spend more on defence. Do you think more and more that is going to be European companies who benefit from that, as the relationship between Europe and the US turns more sour, and maybe it seems like that spending shouldn't be going to US companies? Is it possible that we're actually underestimating the benefits to European defence companies?
Yeah, that European fiscal impulse should benefit more than just European companies. If you take a step back, that fiscal impulse, yes, we know that Germany has the fiscal headroom, but it's not the same for all European countries. It's not the same for the entire region. So I think it's still an open question whether we get that synchronize that union of growth, union of spending in terms of that fiscal impulse. I think that's still an open question.
Yeah. Europe is made up of very different economic outlooks at the moment. Be interesting to see if we can really kind of form that into one cohesive thought. Anne, nice to see you. Thanks for stopping by to join us this Friday morning. Anne Doe, Portfolio Manager at Julius Baer. Let's look at the Core 6 in Europe, give you an idea of what is happening here. It has been a bumpy week, let's put it that way, and we are watching very carefully what is happening in terms of the market moves. But as you can see this morning, starting to unwind some of the gains that Europe has generated. Big names, LVMH, Novo Nordisk, ASM, they're all big names there, aren't they? And they're all under a little bit of pressure. And that takes us to some of the pressure that maybe is going to come out of the United States a little bit later on. Did you see what Nike had to say last night? Did you see what Fedex had to say right now? Let's dig in to some of the pre-market movers stateside with Valerie.
Guy, let's start off there with Fedex. They came out with a profit warning. They reduced their guidance for the full year ahead, and it's actually now the third quarter in a row that they have done so. They cited some weakness in their higher margin business-to-business volumes. The CEO said that there is a uncertain outlook on demand moving forward. Commenting again around the heightened uncertainty for the U.S. economy. Moving on to Nike, those shares also moving lower. The CEO is struggling with his turnaround plan, this glut of inventories. He also noted that margins are due to come under pressure in the first quarter. He noted specifically tariffs on China and Mexico causing some margin pressure for Nike. Those shares are down 4.3% in the pre-market. Lastly, Micron, some good news here, gave an upbeat sales forecast, mostly due by a boost to AI demand. Their high bandwidth memory chips saw some decent sales for the first quarter. Those are the ones used in data centers, Guy. They also said they're on track for record revenue for the year. That's Micron Technology up around 1% so far this morning.
Thanks for the update, Valerie. Thank you very much indeed. Coming up, we're going to continue our coverage of what is happening at Heathrow. The London Fire Brigade, within the last couple of minutes, has said that it has brought the fire at the electrical substation under control. This is the electrical substation that has caused such chaos, though, closing Europe's busiest airport. You're looking at a live shot coming from West London. We will bring you the latest updates from Heathrow in a few minutes' time. This is Bloomberg. Friday morning, good morning, welcome back. European equities are softer. We're up on the week, but we're down on the day. We are seeing a negative picture emerging as well over in the United States. I'm just looking at kind of what we're looking at there. Looks like it's going to be a slow start to the session stateside as well. Plus, we've got witching that we need to work our way through in the options market. So we're actually setting up for what could be a fairly busy day from a market perspective, I would argue. In terms of what else is going on elsewhere, obviously the biggest story that we're watching so carefully this morning is what is happening at Heathrow. Airline stocks, unsurprisingly, under pressure. IAG, the owner of British Airways, is the most affected. Heathrow Airport has been shut down. It has been shut down all day. It will be shut down all day. There's been a fire that's caused a power outage. The fire brigade is now saying that that is under control. I want to go to Alex Morgan. He is at Heathrow and joins us now with the latest. Alex, so we understand the fire is under control. What does that mean in terms of what happens next?
Well, Guy, that's a good question, and we're getting that update in the last few minutes from the London Fire Brigade. They're saying they dispatched around 10 fire engines, 70 firefighters to this major blaze at a substation in Hayes, that's just nearby the airport. Obviously, it took off a lot of local homes, took them off the grid as well. They're saying that fire is now under control. The investigation begins, as in how did this happen? How could it take Europe's busiest airport offline for an entire day? An unprecedented closure. There's no sign that the fire being under control is going to have any change to bringing forward the time which Heathrow will open. It is set to be closed all the way through today. That's going to have a massive impact through the weekend, of course, because Heathrow typically has around 1,400 flights a day. There are around 200,000 passengers coming through here. That's now obviously going to be delayed, not just today, but obviously tomorrow and the day after, because those aircraft, around 120 that were in the air at the time of the closure, they've got to be repositioned. The other flights have to be repositioned. We're going to see days of disruption. Bearing in mind, just a few hours of air traffic control delays can often lead to days of disruption. So, Guy, while the fire might be under control, there's no sign that's going to ease up in terms of the opening time at Heathrow today.
Alex, thanks for the update. You'll continue to keep us updated. Thank you very much indeed for that. Alex Morgan joining us from Heathrow in West London.
What did you say, Guy? The airline shares are down this morning. IAG absolutely feeling most of the pain, down 3.2%, but the same for the likes of Lufthansa and Air France. The other stock that is in the red this morning for another day is UBS, after a Bloomberg scoop that UBS is examining the potential relocation of its headquarters if Switzerland does stick to this demand that the lender should hold an extra $25 billion of capital. And we can get more on this now with Nicholas Comfort, our European finance and regulation reporter based out of Frankfurt. Thank you, Nick. I mean, why is UBS threatening this move? Is it just a threat? Is it just a lobbying device? Or is there a realistic alternative HQ for the bank?
So first off, I mean, the reason they're threatening this is clearly the capital requirement that would come on top. So the Swiss have been notorious for always having what they refer to as a Swiss finish, i.e. sort of they're a little bit sort of a stronger requirement than in other jurisdictions. But this 25 billion, if implemented as described, would really go a lot further than what other big banks face. And so I think from the UBS side, it's probably pure mathematics. They're just saying sort of like, we cannot compete if this is our cost of capital, if this is how expensive then the knock-on effect would be for our loans, for our services. And so that's the threat they're making. I think the word lobbying is very appropriate here. I mean, we're in the kind of the hot stretch of these rules being hammered out. So in May, we're expecting this to be put to the Swiss Parliament. And so clearly, like UBS wants to get across its perspective here and be saying sort of that it's detrimental, and to kind of to sway the politicians if even they haven't been able to sway the regulators. Just on Monday, we had an interview with FINMA, the Swiss regulator, and they're really sticking to their guns, only offering a kind of well, they see it as a concession. The UBS side do not see it as a concession in terms of phasing in, slowly, gradually applying the rules rather than one big bang at the beginning. But that doesn't go far enough for UBS.
What would this mean for A, Switzerland, and B, any other jurisdiction that would be prepared to take UBS? UBS is huge. Presumably other regions, other jurisdictions would have some caution when it comes to such a move.
Very good point. So, I mean, depending on how it would be structured, if this was to happen, then, I mean, the question on Swiss politicians' minds would be, is there still going to be credit flowing from our biggest bank to our companies, to our consumers? Now, it's an attractive market. I would doubt that if this was to happen, that there would be any kind of wholesale departure from the lending market in Switzerland. But yeah, the flip side is much more interesting. What about the other jurisdictions that UBS would be looking to move to? Clearly, there's three big options. You've got the US, you've got Asia, and you've got Europe. Now, the US has become a lot more private industry friendly under the current administration, so that might be attractive. Also, a little bit of turmoil there as well. Asia is a big focus for UBS in terms of the wealth management business, so there's an attractive angle there too. But again, the regulators having this whopping great bank move into your backyard, I mean, clearly they would give UBS a hard time as well. And I'd say the onboarding procedure would be very, very strenuous. And so it would not be smooth sailing to move to another jurisdiction either, Guy.
So, Nick, how do you see this playing out? We had the CEO, Sergio Motti, telling us previously that they're going to make the case for a change to these rules until the very last minute. How much flex is there in these rules from the regulator? Where does this end? How long does it go on for?
I think exactly. I mean, my personal view would be that there will be some kind of a compromise in the end because each party has something to gain here as well. I mean, let's not forget that the S in UBS used to stand for Switzerland. Union Bank of Switzerland was one of their predecessor companies. So much of their identity and their brand and what they can offer to clients is kind of linked to the stability of Switzerland and discretion, the Swiss bankers. And so for wealth management, UBS's core business, Switzerland is a major asset. And so, I mean, that clearly has to be pushing the UBS side towards a compromise there too. The regulators, maybe they're talking tough on this at the moment. Like I said, the FINMA interview we had, they were not open to compromising too much. But maybe the politicians at the end will be the ones who kind of pull us into an area which is something which both the regulator and UBS can live with.
OK, Bloomberg's Nicholas Comfort in Frankfurt. We thank you for the scoop as we look at those shares in the red again for UBS this morning. I want to turn to another stock that's struggling in the pre-market, and that is Nike. Those shares down 4.4% as things stand. And this is because Nike's turnaround efforts are hitting snags as the company tries to clear out old inventory while feeling the effects of the growing trade war. Which company isn't feeling that? We can get more now with Andrea Felsted from Bloomberg Opinion, who I know has got some pretty strong opinions about Nike trainers. But Andrea, first of all, just tell us, what does this set of earnings tell us about Nike's turnaround, how it's going with the new CEO?
It tells us it's going to be slow. I'm not sure if it's hit a snag, but it's definitely going to be slow. I mean, they told us that Q4 sales will be down by a mid-teen percentage. The gross margin could be down by as much as 5 percentage points. It's clearing out this inventory. Interestingly, it said it thought the Air Force One had now stabilised, but it still had too many Nike Jordans and too many Nike Dunks. So it's got to get rid of these overexposed franchises, these sneakers that everybody had and suddenly they've gone out of fashion, before it can really bring in its new products.
So it's reorganising around sports, basically.
That's right.
So football, basketball, etc., etc.
Exactly.
It's focusing much more on sort of the athleticism of the product rather than the fashion of the product. Are we already starting to see the effects of that? What kind of products are we seeing coming out? What are they giving us in terms of the idea about where ultimately the brand will be?
They're giving us some, more running trainers. They're trying to connect with retailers. They're trying to reconnect with athletes, particularly running, where they've come under pressure. But these things will take time. There are some coming out at the moment. More will come out. In the meantime, you've got Adidas taking a very different approach. It's much more focused. It's much more focused on fashion, and it's using its brand desirability to then move back into performance. And it's also picked out running as another growth area. So it's going to be a lot of competition.
Do you know what they need?
What?
Rishi Sunak. They need him to wear a pair of those kill shots. He was the famous ambassador of Samba.
So you bring up kill shots. So Andrea wrote a piece yesterday. Everybody's asking the question, what's the next Samba? Andrea Felstead apparently has the kill shot, the night kill shot. Yeah, this is a tennis trainer.
Yeah, so I'll tell you how this came about. I've become absolutely obsessed with people's feet and looking at what trainers they're wearing. And I just noticed in real life and on social media that there's a few more retro Nikes popping up. So I thought, well, I'll have a dig around. Is this showing up anywhere? And it did show up that on social media, the kill shot seems to be doing particularly well. And they were both very strong, the Samba and the kill shot, about the same time. But whereas the Samba's sort of decelerating, that's quite clear. Yep. The kill shot's continuing to build. Now, there's often a bit of a lag between when things show up on social media and when they show up, in sales, etc. But there's a few of these retro models that are starting to, but, Adidas isn't going down without the fight. So the new one that everyone's talking about is the Taekwondo. And these are very, very low on the ankle. They've almost got no soles, like a barefoot sneaker. And Adidas are putting a lot of focus on that. That's already being tipped as the sneaker of the year.
But how much
so Nike's got competition.
Can it be, but how much of a focus can it be on sports if you're going to collaborate with Kim Kardashian and Skims?
Exactly. Now, they're saying that is performance, body sculpting, but these brands, my view is these brands are fashion brands. You can have performance, you can have athletes, they are fashion brands. And, when you go to Zara, you don't just have one thing that's big. They're already working on what's coming next. And Adidas really Bjorn Gulden really seems to get this. He seems to have a pipeline of products. And I think Elliot Hill's catching on, so let's see if he can do it.
Got my eye on a pair of Miu Miu trainers, Andrea. Maybe this weekend.
Miu Miu, the fondable trends.
OK. This conversation needs to stop right now. I don't know what you're talking about. Anyway, we're going to back to the markets in a moment. Rob Arnott's going to join us. This is Bloomberg. Minutes into the equity session here in Europe this Friday morning. It's negative. It's actually in certain markets quite negative. So as you can see, you are looking at some markets that are down. Let's call it circa 1%, 0.75% to 1%. That's the picture in Europe. There's a story in Turkey that's probably worth drawing attention to. I just wonder if there's a connection here. Turkish stocks are getting hit pretty hard again. You've got fresh halts once again in that market. You did see a ripple effect Wednesday into European assets as a result of that. So Turkish banks are down, let's call it circa 9-10% at the moment in terms of the performance we're seeing there. I draw your attention to it because it's one of those things that just at the margin may have some kind of an effect. Just give you an idea of what is happening there. You can see some of the numbers on the screen for you. The central bank is trying to step into the market as well to have an effect on what is happening with the lira. In terms of what that means for US futures, I'm not sure there's a big read across at the moment. I think there's a bigger reaction this morning in terms of Nike and Fedex, in terms of what we're seeing in the numbers out of the United States today. You've also got a big options expiry coming up. That's going to be a factor in terms of the session a little bit later on as well. At the moment, the S&P over the last 4 days, Monday, Tuesday, Wednesday, Thursday, up by around 0.4%. So the margin in terms of producing another negative week is small. We could see one. So there's not much erosion required to generate another negative week. So that's kind of the setup into this Friday morning. Perfect person to talk to, Rob Arnott, founder and chair of Research Affiliates, sitting around the table with us this morning in London. For how long, we don't know yet. We'll see over the next few hours. Nice to see you.
Good to see you.
What do you make of the world right now? We're in a position where it does seem as if US exceptionalism is coming to a close, and I'm wondering what you think the implications of that are.
Well, one of the things that I think gets overlooked, how many of the people in the corridors of power around Europe and elsewhere in the world have read Art of War? That is Donald Trump's Bible. And anyone who's dealing with him who hasn't read Art of War is making a terrible mistake to not do his or her homework.
Subdue the enemy without fighting.
Yes.
You could quote from it, which is slightly alarming.
Yes. Very good,
Watch out,
Lizzie.
Guy.
We'll probably throw a bit of Machiavellian as well, just to kind of get a bit of the prince into the story as well. We're not sure we go quite that far.
So the EU puts a 50% tariff on U.S. whiskey, and Trump says, fine, and 200% on European wine and spirits.
Yeah.
But, so are you saying he doesn't mean it?
Oh, no. I'm saying that if he gets the EU to back off, then he's won the skirmish without having to fire a shot.
There's a long-term effect, though, of the instability that he's creating for the U.S. economy.
I think it's crazy that Wall Street economists spend a lot of time trying to model what tariffs will do to the GDP, to unemployment, to inflation, when they change day to day. The one thing you can have confidence in is that we're going to see more volatility. And more volatility you can model. More volatility usually means somewhat of a retreat to safety. And a desire to have a margin of safety in your portfolio, which usually means value means growth.
Yeah, we're going to come on to the value and growth in just a minute. We've got a wait-and-see economy. I think this is what Torsten Slok at Apollo talks about. Everybody's sitting on their hands. Nobody's doing anything. To a certain extent, that is true in the markets, but it certainly appears to be, judging by the data, true in the economy.
Yes.
You get a recession in the States. What do you think broadly happens to U.S. stocks from here? We're already down. Do you think there is further to fall?
I think the market can be selective on the way down. One of the things that's fascinating, a lesson of the dot-com bubble, is it burst almost exactly 25 years ago. The first 2 years after the bubble began to burst, from March of 2000 to March of 2002, the S&P was down 27%. NASDAQ was down 50 on its way to being down 80. And so what about Russell 1000 value? It was down 4. What about Russell 2000? It was up 3. What about Russell 2000 value? It was up 53. Meaning that if you had the foresight to pivot from frothy NASDAQ companies into deeply out of favor small cap value, you were 3 times as rich in 2 years as the person who stayed the course with NASDAQ.
Sounds like he's suggesting maybe we should buy value stocks. Rob's suggesting value stocks?
It's possible that I think they're a good deal.
Let me ask you guys' favourite question here, though. So can Europe kind of decouple from the misery stateside? How much of an effect do you see reading through into European stocks? Can it power its own?
European stocks are cheap. They're priced to offer pretty good forward-looking returns. We were known as the inventors of fundamental index. Fundamental index in Europe has a dividend yield of 4.5%. In emerging markets, 5.2%. You can buy half the world's GDP with a dividend yield of 5.2% and participate in the growth of emerging markets economies. That's pretty cool. You can get 4.5% in Europe if you use fundamental weighting as opposed to cap weighting. Even cap weighting has a pretty respectable yield. So I look on a lot of these markets as having that margin of safety. If there is a bear market in U.S. tech, it doesn't necessarily have to be a take-no-prisoners bear market. Bear markets fall into 2 camps: the bursting of a bubble, the dot-com bear market, and a financial crisis. Financial crisis bear markets take no prisoners. I don't see that as being terribly likely in this environment. Now, roll the clock forward. If countries continue to recklessly spend and build up debt, there will be another financial crisis. Just don't know when.
But you think this is more of a fundamental bread and butter economic rollover that is what we're looking at here, despite the fact that it's got a sort of tariff impetus that is feeling pro-cyclical.
Yeah. And the tariffs, it's interesting. Malay has proposed that the U.S. and Argentina, little Argentina, do a reciprocal zero tariff deal on everything. Now, wouldn't it be interesting if Trump says, I'm doing trade war with allies in Europe and allies north of the border in Canada because we're not getting enough respect there. And we're going to do a zero tariff deal with little Argentina. Well, that would be an interesting statement. I don't think the tariffs for him are the end goal. I think getting equal treatment is ultimately his end goal. Yes, he likes tariffs, but the tariffs are used as a blunt instrument, a cudgel, to get his way.
What about Little Britain, which seemingly might escape these tariffs for now? I was looking back in 2021, Rob, you wrote that UK value stocks may be the trade of the decade. And
yes, I did.
Do you still agree with that?
I still believe that. Trade of a decade is not necessarily something that happens instantly, but UK is relatively cheap. It's been dismissed by the markets as a country going into decline. But I know lots of people here who are smart, entrepreneurial, energetic, and this is a country that can flourish. But it's stubbed its toe a little bit, shall we say.
There's a chancellor, I think, that would like to meet you and talk about those things. Can I take you back to the States? Small caps. Why should small caps outperform if we see an economic rollover? It seems slightly counterintuitive.
It might seem counterintuitive, but what's cheap has that margin of safety. And the spread in valuation between growth and value, as is well known, is very nearly the widest in history. The spread in valuation, less well known, between small cap and large cap is very near the largest in history. So small cap value is particularly, extraordinarily cheap relative to large cap growth.
But what we're seeing at the moment so far this year is that small cap is underperforming.
Of course.
Massively.
That's short term. I'm a long-term focused person. I look ahead 5 to 10 years. And on a 5 to 10 year basis, I see very little likelihood that small cap value can possibly underperform large cap growth. The valuation spreads are too wide. One of the things that's interesting is when people look at performance, they don't disaggregate how much of the performance is due to the underlying businesses struggling and how much of it is due to the assets getting cheaper relative to their fundamentals. I call it revaluation alpha. And revaluation alpha can affect big markets, U.S. versus Europe. It can affect categories of stocks, large growth versus small value. The underperformance of small value relative to large growth over the last 2 years has been remarkable, but almost 100% of it is due to small value getting cheaper relative to its fundamentals and large growth getting more expensive relative to its fundamentals. That revaluation alpha is something that when you see it, you're tempted to say, get me out of here, this is bad. But if you look at the relative valuations, you say, oh, the entire drawdown is due to getting cheaper, and that can reverse.
You're going to get in trouble with Lizzie Burden. She doesn't like the use of Greeks.
I do not like the use of Greeks, unfortunately. I've banned Guy from speaking Greek on this programme. Shall I attempt a bit? Where you've got next, where you have, bet on these deleted stocks, it's particularly niche, right?
Yes.
I think I've read you find these reject stocks outperform by 5% annually. How persistent do you think that alpha is going to be in this ETF format then? I mean, how scalable is this if you're looking at it in a public ETF format rather than in a private portfolio?
The recovery and performance of stocks that have been kicked out of indexes is something that I would describe as reliably unreliable. If you go back historically over the last 30 years, stocks that are kicked out of indexes tend to beat those indexes in the aftermath of being kicked out only roughly half of the time. About half of the individual years the deletions win. But when they underperform by an average of 5%. When they outperform by an average of 18%. That's what I mean by unreliably reliable. What you find is that when they snap back, the snapback can be prodigious. So I like that you describe it as a niche idea, because it is a niche idea. Dave Nadig, when he learned of the idea, said, oh, it's a completion strategy. It completes investments in the S&P or the Russell Index because you're picking up what they just tossed out. The difference with deletions, the stocks are by definition small cap and by definition value because they got kicked out because they plunged. Now, small cap value has a long history of outperforming large cap growth, but very unreliably. And the difference between these small cap value stocks and the broad swath of small cap value stocks is that they've once been successful. They know how they got there. I wrote the paper Nixed, The Upside of Getting Dumped. Most of us, I'm sure not you ever, have been dumped once or twice in our lives. And you can wallow in self-pity for life, or you can say, I want to learn some lessons, I want to make better choices, and I want to be a better person. A company that's kicked out can do the same thing. It can say, I know how to succeed, let me regain my mojo. And some of them do.
We like to have contrarians on the show.
Absolutely. Rob, great to see you. I hope your journey home goes well. You're flying back Sunday, yeah?
Flying back Sunday. I'm hoping that the fire doesn't have ripple effects through to Sunday.
We'll hopefully get Heathrow sorted out by then, as you say.
Thoughts and prayers with you, Rob. Rob Arnott, founder and chairman of Research Affiliates, with us around the table. We thank you. Coming up, we're going to have the latest on the day-long closure of Europe's busiest airport, Heathrow. And our weekly doc looks at how BP learned to love oil again. Following the environmental catastrophe, corporate missteps and plain bad luck, BP has been lagging behind its peers. Now it's scrambling to re-embrace fossil fuels, all while an activist investor circles. But is it too little too late? You can watch the full documentary on the Bloomberg terminal.
The cost of living crisis, scorching heat wave, natural disasters. How much worse could it get?
It's really no surprise the term Schadenfreude gets thrown around when an oil company is seen to be suffering.
They want their profits at all costs, at the expense of our people and our lives.
And right now, BP is really suffering.
They lost a lot of money and they lost the faith of a lot of investors.
And 15 years ago, it lost a catastrophic amount of oil. And a litany of boardroom disasters since then haven't made things any easier. And it's attracted something unprecedented.
Bloomberg has learned that activist investor Elliott Management has built a significant stake in British oil major BP.
Even a couple of decades ago, the idea of an American investor taking a stake and forcing the company to rehaul its entire strategy would be pretty much unthinkable.
Yet that's where BP finds itself, amid a fractious realm of competitive disadvantages and a geopolitical outlook fraught with uncertainty.
Airline stocks are under a little bit of pressure, understandably, given what is happening at Heathrow. IAG is the centre of attention. It is down, as you can see, by 3.6%. It operates basically half the flights in and out of Heathrow on a daily basis, as a result of which the outage that we're seeing at Europe's busiest airport is going to affect it the most. Let's get the latest on what we can expect throughout the rest of the day and the weekend. Alex Morgan is at Heathrow for us. Alex, we understand the fire is out, but it's likely the closure is going to last all day.
Yeah, Guy, the fire is out. The London Fire Brigade saying now the investigation begins. This was a fire at a power substation, which meant the airport obviously lost its power, local homes as well. It's taken the airport offline until at least midnight tonight. Now, speaking to some of our colleagues on the Bloomberg Global Aviation team, sort of looking at the words used for this, they're saying unprecedented. This is a full-day closure for what, last year was the world's fourth busiest airport. It's Europe's busiest airport. These are really busy times. So we're looking now at sort of, three parts. The first is, of course, the 120 aircraft which were in the air heading to Heathrow, which had to turn around when the closure happened. Next, you've got today, around 1,300 flights we think are going to be disrupted, as according to data from the flight tracking site Flight Radar. Then you've got tomorrow, the next day, and the day after. Heathrow is not yet able to say when power will be reliably restored. Airlines will be thinking about where to position their planes, their people, and their passengers. So we're looking at days of disruption well into next week. But for today, Guy, it's clear. The fire might be out. The closure is at least until midnight. People are being urged by their airlines, by Heathrow itself, not to travel here today under any circumstances.
Yeah, you'd normally see a few aircraft taking off or landing behind Alex. The airspace is very much empty at the moment.
Yeah,
Alex Morgan outside Heathrow Airport. It's amazing, isn't it? That's not normally something you would experience standing where you are right now. Let's talk about the long-term implications of what Alex has set up for us. Hundreds of thousands of flights, passengers. Everything is in chaos this morning. We don't know what the long-term implications of all of this are going to be, but certainly, as Alex said, it's likely to last a few days. He was mentioning the global aviation team we have here at Bloomberg. The person that leads that is Benedict Camel, and he joins us now. Benny, let's talk about what happens next and the ripple effect that spreads out from the closure of Europe's biggest airport. What does history tell us about how long it will take to get everything back online, everything back to normal?
Well, we just heard from Alex that this is probably a matter of not just today, but really into the weekend and probably into next week. We've been hearing from the likes of Emirates, from Etihad. We haven't heard from the US carriers yet. But it's the Middle East carriers that were in the air, that were disrupted, that had to land elsewhere. That's really going to put a spanner in the works for them. Etihad, for instance, had a big plane that had to land in Frankfurt. They've had diversions to places like Birmingham, like Manchester, Gatwick. You know, if you managed to get into Gatwick Airport, you were lucky. But there are some that are really farther afield, and that's going to cause major disruptions. This is a massive airport with, you know, more than 200,000 travelers. And this is going to really cause these ripple effects. The other sort of, should we say, political ripple effect will be, how could this even happen? How can an airport as sophisticated and as sort of important as this be knocked out by a fire? Yes, a big fire, but still, they should have had redundancy systems. This comes at a time where the airport is positioning itself for expansion. It says we're ready for business, we're ready to do more. So this is not a good look for Heathrow, and that's certainly one of these other ripple effects and the questions that will be asked.
Exactly. How could 5 terminals at Europe's busiest airport be closed by one electrical substation failing because of this fire, Benny? I wonder whether the other airports are going to be rubbing their hands at this point and thinking of the opportunities that could be presented if that political argument is made that maybe Heathrow's third runway isn't a goer.
Yeah, I mean, the airport world is fiercely competitive. Heathrow is still, you know, the big gorilla in the room, as it were, in Europe, but you have Frankfurt, you have Paris, you have Amsterdam, and then farther afield, you have Dubai, you have Istanbul. All of these airports are clamoring for a piece of the action. Heathrow is still where it's at when it comes to transatlantic travel, but this is an airport that's had real issues over the last couple of years. Remember when Terminal 5 opened up? That was a really creaky process. They've had issues with their new scanners. They're probably not going to get their new scanners in on time. So this is an airport. Yes, it's big. Yes, it's sort of a main part of the infrastructure. But at the same time, a lot of things don't go right with this airport. And when they do go wrong, they go horribly wrong. So that will be very closely looked at. It's not the look that Heathrow was hoping for or that the UK was hoping for. They want to be open for business. They want to be forward-looking. And when you have this kind of an incident, it obviously sort of knocks on general consumer sort of confidence.
Benny, looking forward to the coverage from you and the rest of the team throughout the day. Been watching it very carefully already this morning. Bloomberg's Benedict Camel. Let's talk about what is happening in the markets. It's been a turbulent week for so many things.
Was turbulent a Freudian slip there, Guy?
Maybe.
Speaking
There's
of
not
airlines.
much turbulence happening this morning in terms of the aviation sector. At all.
It's a nosedive for European equities this morning. The Stoxx 600 down 0.7% and red across the screen when it comes to the European equity indices. Val Teitel is back round the table. Val, risk on the back foot this morning?
Yeah, it seems like, look, the market has now turned its attention to the next big risk event on the horizon, which is the tariffs on April 2nd. And I think what we're seeing here is just some chips being taken off the table, some profit being taken. We saw that in Asia overnight, those China tech shares, a lot of which that have outperformed recently. Those were the big ones to have some declines. And look, you know, European stocks have outperformed this quarter. We're headed into quarter end. Maybe this is just a bit of rebalancing combined with some profit taking as we want to take some chips off the table, maybe, you know, capture some of those winners before April 2nd when anything could happen.
Sounds like Scott Bessent. Healthy.
Let's talk about witches. What's going to happen later today? So options expiry is usually a fairly major event. This one feels slightly bigger than normal.
Yeah, $4.5 trillion worth of options expiring today. These seem to just get bigger and bigger every quarter as these options markets just have gotten way more liquid recently. So when it comes to triple witching, that's options on ETFs, on indices, on single stocks, all expiring sometimes this afternoon. And look, we could be in for a bumpy session. Let's hope the S&P 500 ends the day in the green, because then it means it will snap 4 weeks of losses for the U.S. equity market.
Okay. In terms of what we're doing at the weekend, I think everybody's weekend plans have just been thrown into chaos. You do wonder what the effect of all of this is going to be. I'm sure all kinds of people are turning out for all kinds of events that aren't now going to happen in the same way that they would have done as a result of what is happening at Heathrow. But the weekend is almost upon us. We've got a bit of rowing that we're going to be talking about later. There's a festival light in Zagreb. There are tulips in the Netherlands and free skiing that we should be watching out for this weekend as well. I hear there's some basketball that we need to be paying attention to too. But Valerie's plans have been thrown into chaos.
Yes, maybe some travel disruption on the horizon for some members of my family. But Lizzie, are you going to be watching the rowing this weekend? I heard you have had a rowing career in the past.
I can't believe someone's told you this. I know that I'm very tall, which you may not be able to appreciate on the TV, but I was a cox because I like to bark at tall men, and I now have a career doing it.
Now I understand. Now I definitely understand. But it does seem as if, the weekend may be changing in terms of its complexion as a result of what is happening at Heathrow. Anyway, you can find the weekend edition on Bloomberg. It's great new coverage that we are bringing you. Interviews, ideas, stories that are exploring all kinds of fascinating places and things to think about. Culture, life, markets, all meeting in one place. Anyway, that is it. We'll continue to update you on what is happening at Heathrow. The brief is up next. This is Bloomberg.